Good afternoon. I'm going to discuss the straight problems and the multiple choice problems of chapter 8 and beginning with problem number 2, straight problem number 2. Now, but before we take problem number 2, I would like you to refer to page 706 of the book and as well as 707, where you'll have the guide for your use of the methods used in the translation process. So if we have to use method number 1, which we call the current or the closing rate method, and method number 2, the remeasurement or the temporal method. So in here, for the balance sheet accounts, you have to classify your monetary assets and liabilities. So for the use of the current or the closing rate method, for the monetary assets and liabilities, you are going to use the current or the closing rate for the method 1. But for method number 2, which is the temporal method, we also use the current or the closing rates. Now, for your monetary assets and liabilities, and you have the specific assets and liabilities, you have to review on this. Then on the other hand, we have the non-monetary items of historical cost, including fixed assets, investment at cost, prepaid items, inventories, and intangible assets. So again, we use the current or the closing rate for method 1, and we use the historical rate for method 2. Now take note of these rules that we have on pages 706, 707, and 708. On page 706, we have the balance sheet accounts, the income statement accounts, in the use of the two methods. So we have now the comparison of the two methods. On page 707, table 85, you have now the translation to currency reporting entity per account classification with distinction as to monetary items and non-monetary items, again with the use of the two methods. And the last part, we have now the income statement items related to non-monetary items. So you have to study this pages because you will be involving a very important rules that you are going to use in the course of filling up or answering the problems. Okay, so we have now your problem number 2. Okay, problem number 2, we have the current rate method translation into the presentation currency against the temporal or the remeasurement method translation into the functional currency. Now, the following accounts are denominated as of December 31, 2009 in foreign currency units. So we have now column 1, the use of the current rate method, translation from functional currency to presentation currency. And column 2, with the use of the temporal method or remeasurement method, translation into the functional currency. So meaning from presentation to functional currency. Now let's fill up the blanks and whatever rate we are going to use. Now we are given the exchange rates for one FCU or the foreign currency unit as of 20x0, x2, x3, January 1, 20x9, April 1, 20x9, July 1, 20x9, October 1, 20x9, and December 31, 20x9. Now we are given this accounts as they are denominated as of December 31, 20x9. And also, we are given the average for 20x9. For reporting purposes, these amounts need to be stated in pesos. For each balance, indicate the exchange rate that would be used if a translation or the current rate method is made. Then again, for each account, provide the exchange rate that would be necessary if a remeasurement or temporal method is being made. The company was started in 20x0 and the buildings were acquired in 20x2 and the patents in 20x3. So in other words, we have to consider the very important dates, including the buildings which were acquired in 20x2 and the patents acquired in 20x3. So we have to fill up the blanks now for accounts payable with the use of the current rate method. Now remember that accounts payable is included as a monetary liability. So on page 706, you are now given accounts payable as part of your monetary assets and liabilities. So we have now to include this at the current or the closing rate under method 1 and the same rate under method 2. Now for our monetary liabilities. So again, refer to your guide in page 706. Next, for accounts receivable, again, being a monetary asset, we have to use current or closing rate in both methods. And we are now using for both accounts payable and accounts receivable being monetary, we are using the current or the closing rate on December 31, 20x9 because the accounts are denominated as of December 31, 20x9. So you look at the exchange rates given for one FCU and on December 31, 20x9, we use 0.16. It's the current or the closing rate on December 31, 20x9. And we are using this because your accounts receivable and accounts payable are both monetary items. Next item is accumulated depreciation. Now we understand that your accumulated depreciation is attached to here we have only one fixed depreciable asset and it is buildings. Attached to buildings is accumulated depreciation and building being non-monetary. Now, if the building, we are going to use the current or the closing rate. So the building, we use the current or the closing rate. So whatever accumulated depreciation attached to the fixed asset for method 1 we use the current or the closing rate. So it is 0.16. However, under method 2, we use the historical rate. For subsidiaries that have been acquired by the parent, the exchange rate on the date of acquisition serves as the historical rate for items that were acquired before the date of acquisition of the subsidiary by the parent. And it stated that the building was acquired on 20x2. The buildings were acquired in 20x2. And the rate applicable, historical rate applicable in 20x2 is 0.26. So the historical rate for the building, the date when it was acquired when was 20x2. So that 0.26 is the historical rate for the building, and the same with its accumulated depreciation. And the same with its accumulated depreciation. That's why under method number 2, for accumulated depreciation, we use the historical rate for the building, which is 0.26. Next, we have advertising expense. Advertising expense is an operating expense, and it's part of your income statement. For income statement, sales, purchases, expenses, and income items that result to outflow or inflow of monetary items under method 1, we use the historical rate or the actual rate. However, for practical purpose, an average rate may be used on the assumption that the items are evenly spread out over the period. So we now assume that sales, purchases, and expenses were assumed, no, are evenly spread over the period. So for operating expenses, we use the average rate for 20x9, and it's the rate of 0.19. It's the rate of 0.19. That's the average for 20x9. Now, 0.19. For the amortization expense on the patents, so amortization expense for the patents, for method number 1, we have now the amortization and any other allocation of non-monetary items, including patents. We use the historical or the actual rate at the date when the expense is incurred, or the average rate if the expense is incurred evenly throughout the year. So this time, we are going to use for amortization of patents. For amortization of patents under method number 1, we use average rate during the year, and it's still 0.19. However, under method number 2, again for amortization, we use the historical rate of original acquisition either at the date of purchase or historical cost items on the date of valuation for items carried at their fair value. So in other words, using method number 2, the amortization of patents should be translated by using the historical rate when the patents were acquired, and it was 20x3. When the rate was 0.25. So that's for amortization. We now use 0.25 and it's H, meaning historical. H is historical. Next item is buildings. The buildings, how do we assign value to the building? So again, for being a non-monetary item of historical cost, we are now going to use for method number 1, the current or the closing rate. Again, I would like to refer you to page 706. So for building being a non-monetary item, non-monetary, then we use the current or the closing rate. So it's now 0.16. That's the current or the closing rate. However, as stated in the guideline, for non-monetary items at historical cost, and that includes the building, we use the historical rate, and for subsidiaries that have been acquired by the parent, the exchange rate on the date of acquisition serves as the historical rate for items that were acquired before. So we now use, for method number 2, for buildings, we use the historical rate for method 2, and that is 0.26. Now the reason is building is non-monetary and we are now using method number 2. So we use the historical rate. Next item is cash. And cash is under monetary. So for both methods, we use the current or the closing rate. So 0.16 being your rate as of December 31, 20x9, the current or the closing rate. Next, for common stock and for common stock, and we have the rule for capital stock and pre-acquisition retained earnings. For capital stock, Mas, okay? So for the next item, we have common stock, and the common stock is included under capital stock or actual. We use the historical or actual rate. So the common stock now for methods numbers 1 and 2. Okay, so we have now the common stock for methods number 1 and 2. We use the rates as of the start of the company. So the company was started in 20x0. The historical rate is 0.28. So for the common stock, 1FCU 0.28, and the applicable rate under methods 1 and 2 is still 0.28 for common stock. Next, for depreciation expense, we are using here depreciation expense as stated. Depreciation, we use the expense assumed to be incurred evenly throughout the year, So for method 1, we use here, for method 1, we use the average rate. That's why we use for depreciation expense under method 1, 0.19, the average. And under method number 2, we use the historical rate. So the historical rate for depreciation, we go back to the date when the building was acquired. And the rate that time, 20x2 was 0.26. So for depreciation expense, method number 2, we have 0.26 H, no, or historical. Next, the dividends which were paid on October 1, 20x9. So how do we assign the rates, no, to this dividends that were assigned or that were declared on October 1, 20x9. So we have now to use the exact rates. The rates on the date of declaration, October 1, 20x9 is 0.20 under both methods. Then we have now the notes payable due in 20Y2. The notes payable due in 20Y2. So we now use the current or the closing rate. The fact that we have notes payable falls under monetary liabilities. So under both methods, we use the current or the closing rate on December 31, 20x9. Next is patents. So how do we assign rates to the patents? Again, on the patents being non-monetary. So we have now under method 1, we use the current or the closing rate. That's for the patents method number 1. However, for method number 2, we use the historical rate, the rate when the patents were acquired. So that was 0.25 in 20x3. Next is salary expense. So for expenses, again, we are going to use the average during the period, either under method 1 or under method number 2. So under your income statement, expenses are included. Under methods 1 or 2, we use average rates. So for salary expense, 0.19 average, and the same with method 2. And last is for sales. That falls under both methods. We have to consider the rates in the average. So for sales, 0.19 and 0.19 man sa second column. So these are the answers for problem number 2. At least you are guided by the rules on pages 706 down to 708. Then we go to problem 3. The current rate method, translation into the presentation currency versus the remeasurement method or the temporal method, translation into the functional currency. So we have now column 1 for the current rate method, that's method number 1, and method number 2, the remeasurement or the temporal method. So you first decide which items are considered to be monetary and non-monetary. So accounts receivable being monetary. Under both methods, we use the current rate. So that falls under rule number 1 on page 706. The accounts receivable being monetary. So under both methods, we use the current or the closing rate. Then we have prepaid assets. We have prepaid assets. For prepaid assets included under non-monetary. For method 1, we use the current or the closing rate. And for method number 2, we use the historical rate. So for prepaid assets, under method 1, we use the current rate, and method 2, we use the historical rate. Remember that prepaid assets is non-monetary. Then accounts payable again being monetary. In both methods, we classify this as current, or we use the current rates. We use the current rates. The fact that accounts payable is classified as a monetary liability. So in the rules on page 706, your accounts payable being monetary using methods 1 and 2 should be stated at the current rates. Then we go to common stock for the rule on capital stock and okay, so methods 1 and 2, we use the historical or the actual rate for common stock. Then for land being non-monetary, for method 1, we use the current or the closing rate. For method number 2, we use the historical rate. Then for goodwill, again, for goodwill, we are going to include in method number 1, we are going to classify it as part of the current or the closing rate, while under method number 2, we classify it under historical, or we classify it as historical. Then we go to sales revenue for the first method and the second methods, no? We use the average or the weighted average. The same here. And for depreciation, under the current method, expenses will be recorded using the average. Now, your depreciation. Well, we use the historical rate under method number 2. Then we go to problem number 4. The current rate method, translation into the presentation currency. Cable Tech, a Philippine corporation, owns 100% of the Canadian company, Fiber Quebec. The Canadian dollar is the currency of record and the functional currency. So we have now prepaid insurance, land, common stock, bonds payable, sales, goodwill, allowance for doubtful accounts, and deferred income taxes. Now, prepaid insurance being non-monetary, and by the way, we have the translation into the presentation currency. Prepaid insurance is under prepaid items. Under the current or the closing rate method, we are going to use the current rate. Land, again, being non-monetary, we use the current rate. Common stock, we use the historical rate. historical regardless of the method. The common stock should be stated at the historical rate. Now, especially this time that we are given in number 4, method number 1. Then for bonds payable, again, bonds payable is included under your monetary liabilities, bonds payable. So we have to use the current or the closing rate. Sales using the average, then goodwill, allowance for doubtful accounts, and deferred income taxes, still part of the non-monetary items, but we have to record this by using the current rate. And you have your allowance for doubtful accounts that's related to accounts receivable being monetary, but still we use the current or the closing rate for F, G, and H. Then we go to next problem for problem number 5. Temporal measurement method translation into the functional currency. So meaning we are now using method number 2. A Philippine corporation owns 100% of Frozen, a French firm. Assume that the peso is the functional currency, although the books are kept in euros. So we now use cash and accounts receivable and bonds payable are all monetary assets and liabilities. So per guide on page 706, monetary assets including cash and accounts receivable should be translated by using the current rate, whereas bonds payable being a monetary liability should be translated at the current rate. While inventory, which is a non-monetary item, inventory on page 706. And remember that inventory being non-monetary, and we are now using method number 2. So we use the historical rate, the same with equipment. It's non-monetary, and using method 2 should be translated by using the historical rate and the common stock at the historical rate, while sales should be presented by using the average. So these are now your problems 3, 4, 2, 3, 4, and 5. Then we are asked to work on problem number 9 before we go to the multiple choice problems. Okay, so problem number 9. The functional currency is the currency of a hyperinflationary economy. Elri company operates in a hyperinflationary economy. Its balance sheet on December 31, 20x4 follows. So we are now given cash being monetary, inventory, and property, plant, and equipment, non-monetary. Current liabilities, monetary, non-current liabilities, monetary, and then we have the total, and then we have the common stock and retained earnings and the total. The general price index and the exchange rates of peso to foreign currency are given. So we have the price indexes and the exchange rates. The property, plant, and equipment were purchased on December 31, 20x2. And this, there is a 6 months inventory held. The non-current liabilities were alone raised on March 31, 20x4. So prepare is stated, then translated financial statements. So we are now in problem number 9 with the requirements. So we have problem number 9. We are going to prepare the restated and translated financial statements. So the currency of hyperinflationary economy, we begin with cash of 420,000 being monetary, and we have now the balance sheet date ends on December 31, 20x4. 20x4. So we still have the current restated rate is 420,000. When we have the exchange rate in 20x4 equal to 300, and here we are given the rate of 175. So we have now 175 considered to be the exchange rate, and we now multiply 175 or 1.75 by 4.20. So that gives us the translation in pesos equal to 735,000. Now we have the inventory of 3,240 being non-monetary, and we have now a 300 divided by 270. 300 is the year end. We are now given 300, and 270 is the average. Adding 240 and 300, that's 540 divided by 2. So it ends up with 270. 3 to 40 multiplied by 300 over 270, we get 3.6 million. So we use the current rate, which is 1.75. So 1.75, and now convert, and we get the total assets of 10,815,000. That should be the total liabilities. So for the current liabilities, which is monetary, we use the current rate, which is 1.75, and we multiply it by the amount of current liabilities. So we now get 1,470,000. The non-current liabilities still converted by using the current rate, and the common stock issued in 20x0 for 300. That's the present rate divided by 100. The date when the common stock was acquired, and we multiply using now the current rate, we get the restated amounts. If the total assets is 10,815,000, we deduct 1,470, 1,050, and 2,520. Then, considering the total asset should tally with the total of the liabilities and shareholders' equity. So we set 10,815 is the total of the equities. And then we deduct the three items. The balancing figure is 5,775,000. So that will be the credit to retained earnings. So we have now M, monetary, N, non-monetary, C, we have the current rate, BA is the balancing amount, and we have now your balancing figure as the difference between 10,815,000 and the total of the other liabilities of 4,990,000. 4,990,000. So that leaves us the balance of 5,775,000. That's now your uh, balancing figure, in 10,815,000 is your total liabilities and equity. So the total liabilities and equity. Okay, so we have now your problem 9, which requires the preparation of the restated. So we have the restated and then the translated amounts. Okay, we have the translated amounts. Okay, now we go to the multiple choice problems. I gave you only numbers 1 to 9, 25 to 26, 52 to 53, and 88 up to 98. So we now will start with questions 1 and 2. Certain balance sheet accounts of a parent company of Parker Company, December 31, 2024, have been restated into pesos as follows. So we have now the restated amounts at current rates and at historical rates. Cash, accounts receivable, inventory, land, equipment, and the total. Assuming the functional currency of the subsidiary is the peso, what total should be included in the consolidated balance sheet at December 31, 2024 for the above items? So we have now the peso is the functional currency as stated. Assuming the functional currency is the peso. So if the functional currency is the peso, a remeasurement or temporal method is appropriate. Cash and accounts receivable, being monetary, are to be measured by using the current exchange rates. So we have 47,500 and 95,000. So that ends up with 147,500. Inventory is non-monetary asset and carried at market value are measured at the current exchange rate of 76,000. Now, even though inventory is non-monetary, however, it should be recorded by using the current rate. We now use the peso as the restated at peso. So we now use 76,000. And the land for this and the land and equipment, both non-monetary asset carried at cost, are measured at the historical exchange rate of 54,000 and 135,000. So we now assume this time we consider land and equipment as non-monetary assets. So they have to be remeasured at the historical rates of 54,000 and 135,000. So assuming that the functional currency of the subsidiary is the peso, what total amount should be included in Parker's consolidated balance sheet? So we have now the amount of 407,500. For the question, we have now letter A. What total amount should be included in the consolidated balance sheet? So that includes the 42,500. Then we have 76,000. And we have the total 142,500. I'll repeat, 47,500 plus 95,000 plus 76,000. It's 218,500 using the current rates. However, using the historical rates, we have the total of 189,000. So 189,000. So we get the total of 407,500. So in other words, we have to show cash, accounts receivable, and inventory at market. Inventory at market. So we now use total of 218,500, whereas by using the historical rates, we use land and equipment. Now take note that inventory is shown at market. So the answer of number 1 is letter A. Number 2, assuming the functional currency of the subsidiary is the local currency, what total should be included in Parker's consolidated balance sheet as of December 31, 20x4? Because the functional currency is the local currency, a translation or current rate method is required. So all asset accounts are translated at current rates. So we have now answer to number 2 is letter B. Then we go to number 3. The following balance sheet accounts of a foreign subsidiary at December 31, 20x4 have been translated into pesos as follows. So question number 3. What total should be included in the translated balance sheet at December 31, 20x4 for the above items? Assume that the local currency unit is the functional currency. So if it's the functional currency, we now use all of this at the current rates. So the foreign currency is the US dollars. So a translation or current rate method is appropriate. All assets are translated at the current exchange rate of 1,270,000. 4. A foreign subsidiary of Jug Jeans Corporation, a Philippine firm, has certain balance sheet accounts on December 31, 20x4. The functional currency is the peso, and the currency of record is the US dollars, and the parents' books are kept in pesos. Information relating to these accounts in pesos is as follows. Uh, we have now accounts receivable remeasured at current rates and at historical rates. For accounts receivable and inventories, prepaid insurance and land. What amount should be included as total assets on Dalia's balance sheet on December 31, 20x4. So we have now the total of 770,000. So 770,000 now it's the sum of 175,000. Accounts receivable should be remeasured at the current rate. Then inventories, 450,000 at historical rate. Kaya nga accounts receivable, monetary. Ang inventories, non-monetary. Then, prepaid, insurance, non-monetary, and land. So again, we have 175,000. We add 450,000, 45,000, and 100,000. That gives us the total of 770,000. Letter C. Next, we go to number 5. And by the way, the explanation for number 4, the peso is the functional currency. So a remeasurement or temporal method is appropriate. Accounts receivable being monetary should be remeasured at the current exchange rate. Inventories is remeasured at the historical exchange rate, being non-monetary, and prepaid insurance and land, both non-monetary, should be carried at their historical rates. Then we go to number 5. Certain balance sheet accounts in a foreign subsidiary of SS company on December 31, 20x4 have been restated in pesos as follows. So we have now restated at current rates and at historical rates. Accounts receivable, current, long-term, prepaid insurance, and patents. What total should be included in SS balance sheet at December 31, 20x4 for the above items? So the functional currency is the local currency unit, and second column is the peso. So we now have the answer to number 5. The foreign currency is the local currency unit. So a translation or the current rate method is appropriate. All assets are translated at the current exchange rate. So we have now the total of 215,000. Now the assets being monetary, some are monetary, some are non-monetary, but we now use the current rates. Then number 6, question. Number 6 is how much depreciation expense relating to the foreign subsidiaries, property, plant, and equipment should be charged in LL statement of income for 20x4. LL Corporation owns a foreign subsidiary with 2.6 million local currency units of property, plant, and equipment before accumulated depreciation on December 31, 2024. Of this amount, 1.7 million local currency units were acquired in 20x2 when the rate of exchange was 1.5 local currency unit is to 1 peso, and 900,000 local currency units were acquired in 20x3 when the rate of exchange was 1.6 local currency unit is to 1 peso. The rate of exchange in effect on December 31, 2024 was 1.9 local currency unit is to 1 peso. The weighted average of exchange rates that were in effect during 2024 was 1.8 local currency unit is to 1 peso. Assuming that the property, plant, and equipment are depreciated using the straight line method over a 10-year period with no salvage value, how much depreciation expense. So in number 6, the local currency units assume that historical rate is not practicable despite the presence of it. The NPS2 requires the use of average rate. So we have now 2,600,000 of property, plant, and equipment. And then we divide it by a period of 10 years and we multiply by 1.8 during 20x4 per peso. So times 1.8 is equal to 144,444. That's your depreciation expense related to non-monetary assets such as depreciation should be remeasured during the historical exchange rate when the equipment was acquired. So when the equipment was acquired, we had the historical cost of 1.7 million that was in 20x2 divided by life of 10 years, and we divide it by 1.5, the local currency unit per peso. In 20x3, we have 900,000, the local currency unit, divided by 10 years. So we have 90,000 divided by 1.6. That gives with 6,250 depreciation in 20x3. That's now for 2 years, 169,583. Then we go to number 7. In January 1, 2024, PP Company formed a foreign subsidiary. On February 15, 20x4, PP subsidiary purchased 100,000 local currency units of its inventory. Of the original inventory purchased on February 15, 25,000 local currency units made up the entire inventory on December 31, 20x4. The exchange rates were 2.21 LCU is to 1 peso. From January 1, 2024 to June 30, 20x4 and 2 local currency unit is to 1. From July 1, 20x4 to December 31. The December 31, 20x4 inventory balance for PP's parent subsidiary should be restated in pesos in the amount of. So for number 7, the local currency unit, we use the current rate method since the term translated was used. A translation for current rate method is required. Inventory account is restated at the current rate. So that would mean 25,000 local currency units divided by 2, the translation rate. That's 2 LCU per peso. So we now get 12,500. Peso is the functional currency. So a remeasurement or temporal method is appropriate. Inventory is a non-monetary asset carried at cost, is remeasured at the historical exchange rate of 2.2 LCU per peso. So that would mean 25,000 divided by 2.2. So that gives 11,364. Your answer to number 7 is letter A. Then we go to numbers 8 and 9. Subsidiary of SB Incorporated is located in a foreign country whose functional currency is the foreign currency. The subsidiary acquires inventory on credit on November 1, 2024 for 100,000 FCs. That's sold on January 17, 20x5 for 130,000 FCs. The subsidiary pays for the inventory on January 31, 20x5, and the rates for 1 FC are as follows. So we have now the rates on November 1 and December 31 X4 and on January 17, 31 and average for 20x5. What amount does SB's consolidated balance sheet report for this inventory at December 31, 20x4? And what amount does SB's consolidated income statement report for cost of goods sold for the year ending December 31, 20x5? So for number 8, the answer to number 8 is letter B. The foreign currency is the functional currency. So a translation for current rate method is appropriate. Now, all assets, including inventory, are translated at the current exchange rate. So we have now 100,000 is to be multiplied by 0.710. Now, that is at the end of 20x4. Kaya mo nang ginapangita the end of 20x4. And 9, what amount does SB's consolidated income statement report for cost of goods sold for the year ending December 31, 20x5? C, there is no indication that the historical rate is not practicable at any indication that the revenue and expense accounts were incurred evenly throughout the year, and at the same time, the historical rate is given. Therefore, cost of goods sold is translated at the exchange rate in effect at the date of accounting recognition, which is the date the assets were sold. So we are now using the rate of 0.18. That's the exchange rate. For the question is asking for the cost of goods sold for December 31, 20x5. So we now use the number 9 is letter C. We have the answer as 18,000. Then I also gave you the 25 and 26. 25 and 26. Then 53 and 54. 52 and 53. And 25 and 26. A subsidiary of Porter Incorporated, the Philippine company was located in a foreign country. The functional currency of this subsidiary was the foreign currency. The subsidiary acquired inventory on credit on November 1, 2024 for 120,000 foreign currency that was sold on January 17, 20x5 for 156,000 FCs. The subsidiary paid for the inventory on January 31, 20x5. Current exchange rates between the peso and the foreign currency were as follows. So we have now the rates on November 1, December 31, X4, and then January 1, 31, X5, and the average for 20 X5. What figure would have been reported for this inventory on Porter's consolidated balance sheet on December 31, 20x4? So for numbers 25 and 26. Numbers 25 and 26. In 25, the term translation adjustments was used indicating that the current rate method is in effect, in contrast to the term remeasurement. So kung maghambal ng translation, we have the current rate method as compared to remeasurement under the temporal method. Therefore, any translation debit which is a loss will be classified under comprehensive. That's number 24. Number 25 ang atong problem. What figure would have been reported for the inventory? 25 is letter A. That would mean 120,000 multiplied by 0.20. A foreign currency is the functional currency. So a translation or the current rate method is appropriate. All assets, including inventory, are translated at the current exchange rate. Since we are using this time method number 1. So we have the total assets for 120,000 and we use the rate prevailing on December 31, 20x4. That's 0.20. While in number 26, what figure would have been reported for cost of goods sold on the consolidated income statement on December 31, 20x 5. So number 26, we use the current rate method, the same as with the situation with number 9, except that the historical rate is not practicable since the rate on January 17, 20x5, the date of sale, was not given. Therefore, cost of goods sold is translated at the average exchange rate for 20x5, and the average is 0.24, and we multiply it by 120,000. So that gives 28,800. Then I gave you problem 52 and 53. We go to numbers 52 and 53 before we move on to the last problem. So for numbers 52 and 53, Manilo has a year end on December 31, 2024, and uses the peso as its functional currency. On November 29, 2024, Manilo received a loan from a foreign bank for 1,520,000 foreign currency. The proceeds were used to finance, in part, the purchase of a new office block. The loan remained unsettled at the end of the year, and we have the exchange rates on November 29, the loan date, and the end of the year, with the exchange rates. The following amount should be recorded by Manlo, ignoring interest payable on the loan. So in number 52, November 29, the following amount should be recorded by Manilo, including interest on the loan. The cash advance from the bank is translated at 1,520,000, and we multiply it by 1, but we have the conversion of 1 peso is to 1.52 yen. So that gives us 1 million and a liability recorded for the same amount. So number 52 is 1 million. December 31 bank loan payable exchange difference that should be recognized in profit or loss for the period amounted to. So number 53 is 84,337 gain. The loan was still outstanding at the end of the period. That's at the end of 20x4, and it's a monetary item kay loan payable. It should be translated at the exchange rate at the end of the reporting period. So 1,520,000 times 1 divided by 1.66 yen. So 915,663. The exchange difference should be recognized as a gain in profit or loss for the period. So 1 million minus 915,663, or 84,337, and it's a gain. Now, the last set of problems I gave you was from number 88 to number 98 before we go to the multiple choice questions. So now we have number 88, 80% ownership. Number 88 here. 80% ownership is acquired in a foreign subsidiary. January 1. The functional currency for this subsidiary is the LCU. At the acquisition date, the following book and market values in LCUs and estimated remaining lives existed for selected assets. So we have now the inventory and the equipment at their book values and market remaining life. Then the January 1, December 31, an average for the year exchange rates were 1.49, 1.58, and 1.53 respectively. What is the amount of purchase differential amortization recorded on the parent's financial records in the fiscal year in the first year of ownership? So in number 88, we now have a letter B. A letter B, the answer is 74,664. With 180,000 minus 137,000. So 180,000 minus 137,000. There's a difference of 43,000. And we add 830,000 minus 650,000 and we divide it by 10 and times 1.53. That's the exchange rate prevailing on December 31 and we multiply the result by 0.8. So that's why we have 74,664. 89, a Philippine subsidiary, 80%. Now it's 80% also, just like number 88. A Philippine subsidiary, 80%, declared and paid dividends on March 31 and September 30 in the amounts of 47,000 and 78,000 LCUs respectively. Assuming that the euro is the functional currency and the following exchange rates exist during the year. What is the total peso amount of change in the investment in subsidiary account with respect to the dividends? So January 1, March 31, September 30, December 31, and the average from March to December 31. So we have now the question in number 89. What is, assuming that euro is a functional currency and you are given the following exchange rates, what's the total peso amount of change in the investment in subsidiary? We have the average rates. So for number 89, so the answer is letter B, 116,752. We multiply for 7,000 times 1.18 plus 78,000 times 1.16 and multiplied by 0.8 because the ownership is only 18%. So we get 116,752. And in number 90, we are asked for number 90. Okay, what's the requirement in number 90? What's the total peso amount of change in the investment in subsidiary account with respect to dividends? Dividends were paid on May 31 and November 13, the amounts of 52,000 and 76,000 LCUs, assuming that the LCU is a functional currency and the following exchange rates exist during the year. What is the total peso amount of change in the investment in subsidiary account with respect to? So for number 90, we now have 52,000 times 0.66 and we add 76,000 times 0.69. The ownership rate is 90%. So actually it's similar to number 89. Then we go to number 91. What's the amount of the 20x6 journal entry on the parents' financial record? So for number 91, we have a credit for 27,200. That's letter C. 120,000 minus 86,000 times the ownership rate. Number 92, what amount will be included in the consolidated financial statements as income to non-controlling interest? So number 92 is the amount of 34,500. We have 1,623 minus 847,000 minus 179,000 and 252,000, and then we multiply it by 0.1. That's now the non-controlling interest because the ownership is 100%. So the non-controlling interest only 10%. So letter D for number 92. Number 93, the question for number 93 is other expenses, 250,000, and cumulative translation adjustment, 85,000. What is the income to non-controlling interest? So for number 93, the income to non-controlling interest is letter B, 7,692. Then for number 94, okay, we now have number 94 for here. The question to number 94, what is the peso amount of the cumulative translation adjustment with respect to the purchase differential that appears on the consolidated financial statements? So for number 94, we have letter C as 1.2 million minus 420,000 minus 190,000, and we deduct 110,000 plus 180,000 divided by 10, and we multiply the whole thing by 1.2 and 20% for the non-controlling interest since the ownership is 80%. So for number 94, it's letter C for 21,000, number 94. Okay, so for the amount of 87,280 for number 94. Now you try to review on the amount for number 94. That's letter C. However, the amount should be 21,320. Then for number 95, 6, 97, and 98, Incorporated, a Philippine company, acquired 100% of the common stock of a foreign company on January 1, 2025 for 402,000. The foreign subsidiaries' net assets amounted to 300,000 foreign currencies on the date of acquisition. On January 1, 2025, the book values of its identifiable assets and liabilities approximated their fair values. As a result of an analysis of functional currency indicators, determined that the foreign currency was the functional currency. On December 31, 2005, the foreign subsidiaries adjusted trial balance translated into pesos contained 12,000 more debits than credits. The foreign subsidiary reported income of 25,000 FCs for 20x5 and paid cash dividend of 5,000 FCs on November 30, 20x5. Included on the foreign subsidiaries income statement was depreciation expense of 2,500 FCs. uses the equity method of accounting for its investment in the foreign subsidiary and determined that goodwill in the first year had an impairment loss of 10% of its initial amount. Exchange rates at various days during 20x5 follows. So we have now January 1, November 30, December 31, and the average for 20x5. 95. The amount should have been recorded as income from subsidiary based on the foreign subsidiaries reported net income. So for number 95, our answer is letter A, 31,000. The foreign currency is the functional currency since historical rate on date of transaction is not practicable to determine. Then PS 21 requires the use of average rate. Here, share in net income FC 25,000 times 100% times 0.124 or 31,000, and we deduct the amortization of allocated excess for the income from subsidiary of 31,000. Then number 96, the receipt of dividend will result in a credit to the investment account for 6,500 regardless of what method used to translate the financial statements of a foreign entity. The rate used to translate dividend declared and paid would always be the historical rate on the date of declaration. So that means 6,500 for number 96. Okay, next we go to 97. Dito ka lang. We go to number 97. We now have the answer to number 97 as 47,580 for number 97. The answer is letter C, and for number 98, we have letter D. Okay, that ends our lecture. So by Monday, we are going to discuss corporate liquidation. Okay, that's for translation. No